Hello and welcome to BST Live. Glad you could join us today where we're going to be talking about mean reversion trading strategies. Who doesn't love mean reversion? Let's get to it. Well, good morning, good afternoon, good evening. Welcome. We're doing the show a little bit earlier today. It's currently 6 a.m. here, so it's nice and early for me, but I've had my coffee and I'm really interested and excited to be discussing mean reversion with our guest today. So glad you could join us for this special episode. Now, our guest is a quantitative manager from JFD Bank, and I accidentally stumbled across a video of his when I was looking for something else, actually, and it was quite a nice coincidence because we had a chat, and I really love some of his concepts about mean reversion. So let's welcome Stefan Friedrichowski. I hope I said the name there correctly, Stefan. I practiced, I'm sorry. Welcome.
Perfect. Thank you very much. Have a good morning, Andrew. For me, it's quite now already in the evening. It's 8 p.m. already. And the pleasure is mine to be here, and good that you stumbled about my video.
Yeah,
it's very good. Thank you.
It was a nice coincidence. So I remember last time we spoke a couple of weeks ago, we had quite a weather difference. It was 38 degrees for me, so it was quite a warm day. That's Celsius. And I think you said it was like -5 where you're from. Do you want to, how's the weather today? Is it still a bit crazy cold for you?
Oh, absolutely crazy. As we speak, we have -7 Celsius. We have snow, and we have a really strange weather situation as we speak, because we have really the coincidence of coming cold air directly from the north, really from -20 degrees. And we got wind from the Sahara, which is a desert in North Africa. So we get warm wind from the south, and the two collapse exactly above Germany. And that means we have, in some areas, even half a meter of snow, which is untypical for Germany. So it's really strange, but -7.
Wow. Okay. Well, obviously you're warm because you're in a t-shirt now, so it's good that we're indoors and we can talk about trading, and that should warm everybody's hearts a little bit.
Oh, hopefully, I think that's why we are here. Exactly.
Yeah, exactly. So how about we start before we get into the whole mean reversion thing? I know you've got a lot of interesting things to share with us today. Can you give us a little bit of your background in trading, just so that we've got a bit of context about what you're going to share today?
Okay, so a little bit about me personally. My background is physics. So I have never been really taught nothing educational-wise to do with trading at all. But I trade, I think, since I'm 20, which is now more than 30 years ago. And after since now 10 years, I do trading as a full-time job. So I switched my career coming from let's say, normal business to trading. And for me personally, it was trying to use what I know about physics, about statistics, to use exactly those kind of tools, those kind of how to think about coming to rules, doing experiments. So because, trading is a little bit like doing an experiment, at least when it comes to trading strategies. And using all that kind of knowledge about mathematics, statistics, experiments, and even coding, programming, that has brought me to trading, especially to algorithmic trading. So that I have done for a couple of years, just by my own. And then finally, you mentioned already the broker at JFD. They came across and said, "Hey, Stefan, we know that you are doing trading strategies. Can't we do it together?" And so that JFD can use my trading strategies for doing their wealth management. And that's what I'm doing now. as a freelancer for JFD, developing trading strategies, completely algorithmic, nothing to do discretionary. No, it's all about algos, expert advisors, and stuff like that. So that's about me.
Okay, and how did you discover mean reversion?
Oh, discover mean reversion. That was a little bit funny because I think somewhere in the internet, I simply read a sentence like 70% of the time, markets are ranging and they don't show a trend at all. And then I thought, okay, it's from a mathematical point of view, that might be a little bit difficult to prove, because really to differentiate between trending and ranging is really a hard job. I mean, you can do it afterwards when you look to a chart. Always, that's easy. But if you are in the chart live now, to say, hey, we are ranging or we are trending, that's difficult. But that number, most of the time, the market is ranging and not trending. That was, let's call it an alarm signal for me to say, maybe it should be better that I'm not looking for trend trading. Let's look for something which is doing the opposite and doing reverse stuff. And that was the starting point to say, let's have a closer look to mean reversion, in the sense of, at the starting position, doing the opposite of trend trading. Jump into a trend and hopefully the trend follows. And then I said, okay, even if I can prove the number, 70% of the time the markets are ranging, but we can do a little bit different stuff. And different stuff is, hey, let's look whether we can find candle situations which are reversal, or whether we can find other hints that markets are not as strong trending, or maybe not markets, but some currency. Some currencies show that kind of behavior more than others. And that was the starting point to do it more analytically.
Yeah. And if I remember rightly, when we had a discussion, that was also the starting point for you building mean reversion strategies, is that you've got to look at the market and match the market to that particular style first. So can you share with us some of the techniques you use to determine if a market is good for mean reversion or not?
So the basic idea was, let's look for Forex. So that was the first decision, looking for mean reversion strategy, which is symmetrically, so doing short and long trades in both directions. So Forex should be a good marketplace for that. But the next idea was to say, can we show directly that markets are more reversing than trending? And then I thought, okay, let's think about not regular candles like H1 candles or D1 candles, so time-based candles. No, let's ask for price-based candles, or better to say, just bricks. So a lot of people may know Renko charts as a good example. For me personally, I'm only talking about bricks, and those bricks are they have a percentage number. And I always look for percentage numbers, not like other people would do. They may say, okay, let's have 5 bips candles as a brick size. But then you have always a difficulty to compare euro, US dollar to New Zealand dollar, Swiss franc. simply because the one might be at a price level of about 2, and the other might be at a price level of about 1. Or Japanese yen currencies have 100, but they have a different definition of bips. But anyhow, so doing everything percentage-wise equalize all the different kind of markets, which is perfect. And then I started to investigate those bricks and those kind of bricks combinations. And maybe it might be a good idea that we have one slide, the one with those bricks, because they are showing already a very good first hint why mean reversion is a quite good trading idea. Let's call it up to now just an idea.
Yeah.
First, what is that kind of chart? What we see here are bricks, and those bricks are based on one currency pair, which is Australian dollar, Canadian dollar. And those bricks, they have a fixed percentage height, which is in this case 0.3%. So with some small exceptions, we have some of those. All bricks are equal in their height. But from time to time, especially when it comes to weekends, we have even in those kind of candlestick formations or in those kind of charts, we have gaps. But anyhow, you will, for example, about candle number 19 or 20, there we have a weekend gap. But anyhow, that's not the point here. If we simply look to that kind of picture here, that bricks, which represent, I think, 2 weeks of, or maybe 3 weeks of Australian dollar, Canadian dollar, there's something already obvious. It at least for me, it's jumping into my eyes. Yeah. And that is, in a lot of cases, after a white brick, we have a black brick.
Right. Yeah.
So we have tens of cases here that after a white is followed by a black and vice versa. Hey, that is a quite strange behavior. And that is already some kind of mean reversion, but on the lowest level, that we have the move upwards, which is followed by a move downwards. Wow, great. I say great because what we have here is already the first very good hint for an edge. And that is, to have an edge is always, the starting point of any trading strategy, that we see something which is not, let's say, not as being random. And obviously, we have here something which shows us already an edge. So that's great.
Right.
Okay. Honestly, whenever somebody like me wants to show something which is nice, he picks an example which looks or confirms exactly what he is stating,
yes,
or
exactly.
what his conclusion is. So in my case, nothing different. Therefore, we saw exactly that the chart. But realizing that chart brings us to the next step of investigation. Do we find that, for example, for the last 15 years, so not just for 3 weeks, and we just saw an example for Australian dollar, Canadian dollar, which later will turn out, which is a good one for mean reversion, but there are some other which are good for mean reversion as well. So, but nevertheless, that was an example. Okay, it was the last 3 weeks, but it was picked by me.
Yeah. Before we
So
move on, can I just ask you a few questions about this, just to clarify a few things in my mind? So, we're using this type of chart to remove the time element. So, does this kind of analysis not work as well in using a time chart? Is it not as visible, or why specifically do you do it like this?
Okay, a very good question, because I could have done the same analysis in classical M5 chart or H1, D1, so whatever time frame we go for. And finally, so the strategy which I will show, or which we discuss here, is actually running on an H1 chart, which is a time-based chart. But for that kind of analysis, showing that we have a preference of, after a long candle is followed by a short one, and vice versa, it's much better to have those brick candles, because all the bricks are of same size.
Right.
Doing the same analysis for a standard time-based chart, okay, then we might have a long brick of this size, and the next H1 might be a short brick of this small size.
Yeah.
Still, it would confirm, and it confirms the basic idea of we have an imbalance of the combinations of the sign of consecutive candles, but it's not that or as visible as in those brick-based candles.
Right.
So therefore, brick-based candles are very good, especially in order to visualize that kind of basic idea. And on the other hand, I simply like to introduce or remind everybody who is looking for trading that there's always another kind of potential or charts. And those are not the time-based, those are the price-based. And from a mathematical point of view, those price-based candles have a big advantage, because we all know, at least from a German perspective, the nights are quite boring when it comes to Forex trading. So for me, the night, typical night, the evening would start as we speak, let's say at 8 p.m. German time, and then for the next 10 hours. So for you, Andrew, it would be exactly your day, or at least the early day. And for the US guys, it would be starting already at the early afternoon. But looking for that period of time in Forex candlestick charts means they are boring, because nothing is happening, or at least the candles become small and quite noisy. And if you go for those brick-based candles, then it might be, if you have a brick size of, let's say, 0.1%, that a complete night, my night, fits into exactly one candle. So I don't have that wiggling around. I have just one candle. That's all. Yeah. And back to the mathematical point of view, you can show it, but that can't be done in a few minutes, that the information content, mathematically speaking, information content is higher for brick-based candles than for time-based candles. Right. And that has to do with the noise level, which is, you see, overnight, by night. And so the information content is higher for those brick-based candles, which is something quite fundamental and interesting.
Yeah, yeah. Okay, and then just one more question about that chart before we move on, because I know you've got a lot more to share, but I think in that example it was like 0.4 or 0.3% range or something like that. Why that value? Do you look at this over different ranges or?
Okay, so you can do the exact same analysis for different kind of brick sizes. This is an example of quite big candles already, or because 0.3 is already, let's say, something which is compared to time-based candles. The 0.3 would be in the range of D1 candles. So if you just do it statistically, so such a candle is a typical 1 day. But you can do exactly the same analysis from 0.3% candles down to 0.03 candles, which is already more like an M3 chart, so 3 minutes, if you go to a 0.03 chart. So it has nothing to do, also the basic analysis or the conclusion has nothing to do with the size of the bricks. But, for example, if you want to trade directly what we have seen in the chart a minute ago, then definitely you need bricks which have more the size we have seen, like 0.3, because if you want to trade all those changes and think about those bricks would only be 0.03, so it would be really small bricks, then the costs of trading, like spreads and commissions, would be already a huge part of that brick. So when we finally want to transform those edges, those findings we discuss here, to real trades, we have to incorporate costs as well, and then we can't use those tiny bricks because those would be too small, or the costs of trading would be too high compared to those bricks.
Yeah, okay, that makes sense. Yeah, thanks for clarifying that. Now, I think we were just talking about, before I interrupted you, we were talking about that 2-week range. I think you were going to move to a larger range. Now, do you want to talk a little bit about that?
Oh, yeah, because as I mentioned, I picked that chart a little bit by purpose. Of course, I think
yes.
everybody can excuse that or knows that people who talk about some analysis, they always show an example which fits to what they try to conclude. But now the question is, hey, can we have the same kind of picture for a huge range of time? So let's say not only for 3 weeks, now let's say for the last 10 years. So I did the same kind of analysis for a bunch of different Forex pairs and asked myself, hey, okay, when we look to a combination of 2 bricks, then we have only 4 potential combinations.
Right.
A long brick can be followed by a long brick, or it could be followed by a short brick. So there are 2 combinations, long or long short. Okay, the first one could be a short one. That could be followed by a long, or it could be followed by an additional short.
Yeah.
Okay, so we have just 4 combinations. If you look to 2 bricks, we have 4 potential combinations of those 2 bricks. If everything would be random, then each of those would be 25%, so 1/4. Or better to say, if we look for already a little bit for mean reversion compared to trending, it would be that long short and short long together would be 50% if everything would be random, or long, long, and short, short would be the other 50%. Okay, now let's do the analysis for 28 different Forex pairs, plus, I think, gold put into the analysis as well. So 28 different Forex pairs, and ask, do we have an excess in one direction, like long, short, long, or trending long, long, short?
Mm.
And now I think we can look to that analysis on a chart, and that is shown here. Yeah. So what are the pictures telling you? Now, I really want to have statistics. Therefore, I reduced the brick size, in this case, to 0.08. The principal behavior you will find for other brick sizes as well. But this 0.08 is compared to candle time-based candles is already a little bit between half an hour and 1 hour chart typically. So it's or to mention that I'm doing here some already significant statistics. The number of bricks per currency pair being analyzed is here exceeding already 200,000 bricks per currency pair. So my message is simply, there's already statistics behind. So it's not an analysis based on what we have seen in the previous chart with 30 candles. And I draw the conclusion, hey, we have more long-short combinations or short-long than the two bricks that go in the same direction. Yeah, and now we can look to the result here, and really starting to the first one, and then with this one is starting with Australian dollar, New Zealand dollar. Let's start with that one on the left-hand side.
Yeah. Yep.
There we can see that we have 58% of all candle combinations, two candles as to be combined. So we have an excess of 8% to a reversal. So after a short candle, we have a long, or vice versa. And obviously, mathematically, it must be just 42% that we have potential long, or short. Hey, that is an 8% edge, which is really something which is already heavy, which is really good compared to random. And it's a period of time of more than 10 years being analyzed for that kind of analysis. So it's statistical significant. Still, I have to admit, if you would trade with those 0.08 brick sizes and just would have, you would follow that rule. Okay, I have a long candle, then I open a short trade when that candle is finished, and you do the opposite as well. Still, you would not have a profitable trading strategy because of the costs. Just to give you an impression of costs, I know because that kind of numbers like 0.08% bricks, what is it? Okay, I give you an example. For typical brokers, the costs of trading are about 0.01 to 0.02%. So that means from those 0.08 bricks, 0.01 to 0.02 would be the costs of trading. So that 8% edge is on the edge of being profitable when we incorporate the costs of trading as well. So therefore, I mentioned that. But the message here of that picture is quite clear. Starting on the left with Australian dollar and New Zealand dollar, and going the complete list down, we see that that kind of edge is getting smaller and smaller to the right-hand side. And what kind of currency pairs we see on the right-hand side, honestly, maybe those which are the favorites of many traders. At least in I can say for Germany or Europe, Euro US dollar, yeah, maybe would be the one which is traded most in Europe, or even gold. Gold is the last third here. So you find maybe those you like most on the right-hand side. But at least what that picture is telling you, hey, they don't show a good mean reversion behavior. Because regarding that kind of analysis, the combination of two bricks, those currency pairs are close to random, complete random behavior. When it comes to just it, I don't conclude that Euro US dollar is random. No, that's not my conclusion. If we do the analysis of two bricks, then the behavior of Euro US dollar is close to random, which is not the conclusion that it is random at all. But anyhow, we see on the left hand some very good candidates for mean reversion strategy, which is brilliant because there we have, let's take the first 6 currency pairs. We find Australian dollar, Canadian dollar, Australian dollar, New Zealand dollar, Canadian dollar. So we can already have a hint, hey, maybe that kind of triple Australian dollar, New Zealand dollar, Canadian dollar, those 3 currencies, which create 3 currency pairs, might be a quite good thing for mean reversion. And that analysis is, for me, already a very good, let's call it already a proof of that approach for at least those kind of currency pairs.
Yeah, yeah. What I find interesting about this chart is that at this brick size anyway, you don't see any currency pairs that are more than 50% long, or short. When I first saw this chart, I thought, okay, so that means, I actually misread this until you just explained it then, but I assumed those currency pairs on the right means that it's trending, but as you just explained then, that means it's essentially random because it's sitting 50-50, right? So that's a very interesting observation.
Yeah. So at least coming to the point of being trending or not, let's draw the conclusion here a little bit different in a way. At least when we look to 2 candles, just 2, then within those 29 currency pairs, if I just name gold an additional currency pair, then we have 29 here. Yeah. For a 2 candle combination of 0.08 bricks, we have not a single trending pair, currency pair, at least for 2.
Right.
I know that if you're talking about opening trades for trending systems, then typically you open a trade with a small stop loss and a wide take profit with risk reward ratios of, let's say, 3-1, something like that. But that chart has nothing to do with that kind of analysis. Therefore, we don't find anything, no hint for trending behavior. But we find the other ones, and that is mean reversion, which is already excellent.
Yeah. So if you were to extend that bar size to, zero point 0.1 or 0.2, would you expect to see a very big difference in the results?
No.
You wouldn't.
So
Okay.
I have those results, and I've done the analysis. The only difference you would see is that the number becomes smaller. So if we enlarge the brick size, let's say from 0.08 to 0.2% brick sizes, then our 58% for Australian dollar, New Zealand dollar would go down to 52 or 53. So it's not that huge. But the overall behavior and even the sequence of, or the order of currency pairs, like Australian dollar, New Zealand dollar on the left, and US dollar, Japanese yen on the right, we have small changes in the precise order, but in principle, the order doesn't change. So it's more or less independent from the brick size, which means it's more or less independent on the time frame. So, which is quite good.
Yep. Okay. All right. Well, we might move on now. You've shared some really interesting stuff about market selection. Now, in my notes here, I wrote down a quote that you mentioned when we had our initial discussion about coming on the show, and it was this: mean reversion logic is quite independent of the indicator. I thought that was an interesting comment. Can you explain a little bit about what you mean there?
So there's one thing. When it comes finally to mean reversion trading strategies, then we need something which we call we need something which we call a fair price. So now we let's say we do a jump to the real trading strategies. Up to now, we talked about bricks. So we just asked from one brick to the other and nothing else. Let's now think more in regular charts like H1 charts. So then mean reversion should be something like, now the price is jumping in one direction, let's say north.
Yep.
And then we expect, hey, it's a good idea to open a short trade so that the price comes down again. And that is exactly mean reversion. So something is turning out excessively in one direction, and we are looking for the correction of that. But now we need a measure of what do we call normal. So what is the mean? So because we want to measure something which is deviating from that mean. So I need I need a unit, a measuring systems, a metric for that. And then my first idea, and still that is the one I like most and which works best, I simply take an EMA, an exponential moving average, as being, and I simply, when I start to do that analysis or the trading strategy, I simply just stated that's the fair price. I take that, no discussion, simply because what should I take as a fair price? I mean, everybody, we could have a debate for the next 3 hours. What's the fair price, the current fair price of Australian dollar, US dollar? I have no idea where the price is, but to have a discussion about what is the fair price would even be more complicated. And therefore I said, let's define an EMA price as being the fair price. So that was a starting point for mean reversion, and it still is the one I use. But now we can ask, okay, even if we have, we say we take an EMA, everybody knows when we talk about an EMA, we have to say which EMA period and which time frame. But even if we decide, okay, let's look for H1 time frame only, we have to say, okay, which EMA period? Okay, next difficult question. So we have to decide whether EMA 100, EMA 20, or 4. And it turned out it doesn't depend, the final strategy doesn't depend that much of those EMA periods. And it even, we can think about other ways of defining the fair price. For example, we can use the indicator relative strength indicator.
Yep.
So it's the one which is more or less when the price goes excessively in one direction, it would be +1, or other people would name it +100, and the overbought region, or when it goes to -1 or -100, you might call it it's the oversold region. Yeah, and then obviously the fair price would be an RSI value of 0, which works as well, which is not that bad. The idea always behind that mean reversion is that we have that huge deviation from whatever we call the fair price or the normal. And the good thing is it doesn't depend that much of to the exact choice of the indicator and the indicator period, which is good. So because it shows you that it's a more fundamental story behind mean reversion. And that is, on the one hand, markets have a tendency to exaggerate, to excess behavior, that we go in one direction and then jump on it and goes a little bit more to the north, but then it stops and it comes down back again. And so a lot of people try to jump on that move going north, but then all of a sudden it stops and goes south again. And this always going in one direction too far is what I would say is the typical behavior of markets at all, that it goes in one direction a little bit too low. And on the other hand, that is exactly what we try to profit for mean reversion. And therefore it works that good.
Yeah. So I guess the next question of that is, how do you measure what's too far? Like when the market's moving away from the mean, what techniques do you use to measure where you should really pay attention, perhaps enter a trade?
Okay, now let's do it a little bit more precise, because up to now we just said, okay, as you mentioned, we are too far in one direction. So, and I mentioned already, the EMA is not a bad thing for being the fair price. The EMA value, the calculated price for the EMA. Then the natural thing of measuring the deviation from that fair price is quite simple. Let's just measure the percentage distance of the current price compared to the EMA value, and let's measure that on a percentage base because then we are neutral against all those different currency pairs. Either they are at about 100, like Japanese yens, or they are like euro US dollar. So let's just measure the percentage difference or deviation from the actual close price of a given H1 candle to the close-based EMA value. And let's measure that in percent. Then we have a neutral measurement of the distance. And we can just say, hey, if we exceed a certain threshold, that's a trigger point to open a mean reversion trade. And it would be the threshold, let's say, is neutral for the sign. So we would measure the percentage in distance of the current price. So that is the absolute value. If that it would exceed a certain threshold, that is our trigger signal. And the direction for the trade, of course, is into the direction of the EMA. So that means if we are above, we open a short trade. If we are below, we open a long trade. So that means we have already 2 degrees of freedom. One is the EMA period. Still, we have not defined that, but at least we decided, okay, let's do it on H1 time frame. But now we have already 1 degree of freedom, which would be the EMA period. And the second degree of freedom for entering the trade would be that threshold. If that threshold is exceeded, that we really open a trade. So we need a threshold number, for example, like 0.2% or whatever number finally. But that means we have already 2 degrees of freedom.
Yeah. Why do you have you ever tested using a volatility measurement like ATR rather than percentage? Because percentage, I guess you have currency pairs at different prices, they move different amounts, so the percentages could be all over the place depending on which currency pair you're looking at. So have you ever looked at volatility measurements instead to measure the distance from the mean?
Okay, I have done this, and it's really an excellent way, what you mentioned here, to do it, let's say, neutral or in a common sense to all markets in just one way, because we know we have markets which are more volatile, or currency pairs which are more volatile at all than others. Just an example, US dollar, Japanese yen is always more volatile than euro, Swiss franc, which that one is always, with one exception, that was the 15th of January 2015, I think. The volatility of euro, Swiss francs is always close to 0. But anyhow, back to your question. I have done this in terms of measuring the distance in units of ATR. So ATR is the average true range, which is more or less a direct measurement of volatility. If you have high ATR values, then prices would go more pronounced up and down, or more heavily up and down. So we can use that ATR at a given time as being the unit. So it's a measuring unit. So finally, it would, what I mentioned a minute ago, I measure the distance in percent, would now be I measure the distance in units of ATR. So if we would have then such an excess in one direction, it would be maybe, the current price is more than 5 ATRs away from the EMA. Yes, I have done exactly that kind of analysis, and it works as well, which is good.
Yep.
I still decided to go that percentage way because of it's a little bit more simple. Because if you go for the ATR, you have the next degree of one additional degree of freedom, which is the ATR period.
Yeah.
You have to define another period. There's a trick. Just equalize or that period with your EMA period, then you can still say you have just one number, which works, and that is a good trick. But what I do finally is always for my trading strategies, I use that walk forward methodology. That means, still, if you look for that kind of trading strategy, we are looking for how to optimize our trading parameters, like EMA period, like that distance threshold, either in percent or, as you mentioned, in values or in units of ATR. And we would need an additional one. We need stop loss and take profit. But anyhow, what I always do is I do that optimization of parameters with a walk forward methodology, which means that I use a certain period of history and then looking around, what are the best parameters I can find for that kind of trading strategy, plus some additional things I always check when I do that, like, for example, neighborhood analysis, so avoiding overfitting, just to give a keyword for that. But I want to come back to the walk forward. That means, okay, we look for a certain history in time and optimize our trading parameters, and then we use those for the next couple of days. But that is a quite important parameter. The next couple of days. So we have to decide how often are we doing that re-optimization.
Yeah.
Always when it comes to walk forward methodology. And my simple observation, first tell you the conclusion. Since I'm doing that exactly that way, and my re-optimization period is always something between 2 weeks and maximum 1 month, is quite short. That means I'm following those market changes, which always happens. Like last year, March, volatility was going up because of Corona crisis, calming down later in summer. Since I have always that re-optimization quite often, I'm always adjusting to the current market situation. So I'm let's say quite tight to the current market situation.
Right.
So I'm following those market changes of market conditions, and therefore I don't need finally that combination to volatility, because I'm into that already, because I'm doing those re-optimizations quite often.
Yeah, that's an interesting way to look at it. I'm glad you shared that with us. Now, I'm conscious of our time because we're almost out of time, but I really want to speak to you about another important aspect of mean reversion trading, or trading in general. If you've got a couple more minutes, that's exits. So I know we could probably talk for another hour just on exits, but
oh yeah,
I know it's getting very late for you here. We appreciate you staying up late to talk with us today. Can we talk about perhaps stop losses first?
Oh yeah, let's. We because we know we definitely need both, and let's do it practically.
Okay, sure.
So we have. Let's go to the fourth slide. because
yes.
then we have already a complete picture of how the strategy is running. And we can use. No, go ahead. Yeah, this one. Oh, that's
Sorry.
perfect.
I
No,
actually
not
forgot
this one.
about the slides. Do you want to talk about this one? Did we skip one or
no?
Next one.
Let's go exactly to that one.
Okay. Yeah.
Because now we can at least we can definitely already visualize of how the strategy is running, and we can talk about the take profit directly within the chart. But still, as you mentioned, we have two open points, and that is stop loss and take profit. Those two open points. And let me use that chart at least to directly introduce the take profit. What you see here within that chart, that is an H1 chart of Australian dollar, Canadian dollar. And we see three lines in the chart. The middle one, the red one, is simply an EMA. The EMA within that chart. And then, at least for those who know or who are familiar with MT4 as a trading platform, there's an indicator which is called envelope. And that indicator is drawn within the chart. So that indicator is really simple because it's an EMA with a plus deviation and a minus deviation. So therefore, the blue lines are following the red lines 1-to-1, but with a constant percentage difference. So that is how you use mean reversion, or for that indicator for mean reversion. If we start, for example, on the left-hand side, let's say when we first go out of the upper blue line, that would be exactly the point in time to open the short trade for mean reversion. Okay, if we are there, we need the take profit and the stop loss. And now it comes quite easy. The take profit is simple, the red line, the EMA itself. So the take profit here is a fair price as it is. So that's the one. And we will talk about that potential take profit in two variants. The stop loss is still one additional optimization parameter. So in this case, you still would use stop losses, which finally brings you to risk reward ratios of smaller than 1, not trending like I mentioned an hour ago, like 3-to-1. It's more 1-to-3. It's just the opposite. So you would have stop losses of maybe 0.5%. The blue line here is 0.25% away from the EMA line. So, but still, the stop loss is an optimization parameter, and we will change it from optimization period to optimization period. And to take profit, finally, we can have quite two straightforward potential take profits. And the one is the EMA from the point in time of the open of the trade, right. And then we keep that take profit always as it is, fixed, or we can use the EMA moving up and down, which would mean from candle to candle, we would shift our take profit to exactly that value. So if I look here to the chart, and I think we all can think about the opening of the first trade to the short direction, which would be about the candle, the 15th candle in the upper left corner. And then that trade, by the way, would be a profitable trade because we would reach 10 candles later, we would reach both kinds of take profits. The one with the moving take profit, which would be the red line itself.
Yeah.
So from 1 hour to the other hour, we would change a little bit our take profit. But even if we would do the way I do personally, because I use just the fixed one. So take the EMA value at the point in time of the open of the trade is the take profit of the trade for until the trade is coming to an end. I fix that and fix it constant, and so it's constant, the same value. And that's all. So we have the take profit as being just the EMA value, which is quite easy.
Yeah. Okay. So I think in your example here, I don't know, the EMA seem to be working or moving pretty slow. Maybe that's like a 20 period or something by eyeballing it.
Yeah.
So in the case you're talking about there, where you take the value at the point of entry and you just keep that rather than moving it, I guess in a longer period EMA, there's not really going to be much difference between the two prices, right? But what if you're trading a shorter period and the EMA is moving quickly? Have you looked at that? Does it make much difference?
Yeah, then the difference is becoming more pronounced. But what I can tell you generally, that is now H1. If your EMA period would be smaller than something like 10, the strategy is not profitable at all anymore. So the EMA period should not be that small. And I think we can already think why the strategy would not be that profitable anymore, because the EMA is not anymore really the fair value. If the EMA period is too small, the EMA is following the price too fast, so therefore we lose that character of being the fair value. We are simply following the close price of any candle. We need something which is not that fast. So the preference of EMA periods here is more like 100 or 50 or 200, so more to the longer range. And then, as you mentioned, the difference between those two potential exits of take profit is smoothing out, is more or less, there is no difference, because when you go for an EMA 100, it doesn't change that fast. So
yeah. And then do you adjust the period of the EMA based on the time frame of the chart? So difference between a 5-minute chart and a 1 hour chart?
Yeah. So because definitely the answer is yes, because that would be worth in a complete episode. That has a little bit to do with my thinking. Of course, the EMA periods have to change when you change the period of the time frame of the underlying chart. It cannot be any more the same because of fundamental reason. What matters is price changes within given periods. And they do not change if you change the period of your chart tool. So if you think, how far away the price goes within 20 hours, then the answer is, let's say, universal, more or less. And would not depend on you pick an M1 chart or an H4 chart.
Yeah.
There's no difference. Therefore, of course, if you change the period as a time frame of the chart, you have to change the period of the EMA, or as the EMA period. So you have definitely to adjust those values. Yes.
Okay. Right,
and that, by the way, is done automatically because of that walk forward methodology, because it's always done, let's say, by the price history itself. So it's not my free choice, so to say. It's what comes out of the optimization. That's all.
Yeah, right. Okay. Okay, thanks, Stefan. Now, we got a couple of questions in the chat. So do you have a few more minutes to spare? We can go through a couple of questions. Excellent. All right.
Oh, perfect.
So I just got a comment here from Guy. I'm just going to put this up on the screen. G'day, Guy. Can you explain a little bit more about where the stop loss was? I think that this came up when we were looking at that previous slide. So maybe I can put that up on the screen if you want to explain a bit more. Let me... There we go.
Okay. Here, the typical distance of the stop loss is between twice and 3 times the distance to the take profit. So the final value, once again, is a matter of optimization. But what I just have out of my head is what is a typical number. So if you would enlarge that chart and measure the difference between the take profit and the entry, which is in my case here simply the difference between the red line and the blue line, and because that is a take profit level, so the stop loss would be between 2 times and 3 times away, or more away than the take profit. You may think, okay, why is that? We still need, let's say, room. We need room for movements. The characteristic of a mean reversion strategy is a quite huge hit rate compared to a trending strategy, and a little bit you buy that hit rate with reward ratios of between 0.25 to 0.5. But still, you have that edge that finally the strategy is profitable. But that is a typical number for the stop loss distance for that kind of strategy.
Yep. Okay. Thank you. Guy says cheers. So nice one. I've got a question here from Yam Keller. I haven't seen this name before. Yam Keller, welcome. If this is your first time, thanks for the question. Okay. I trade FX. I've backtested hundreds of strategies, directional, thousands of trades on a portfolio of 28 pairs. I haven't found a single strategy that works on all pairs. Is this normal?
Short answer, yes. and let me answer the question a little bit more than just with yes.
Okay.
Because we have had already in today's webinar here already a quite good hint. If you go back to my slide number 2, that we find already a hint to why that is normal. Exactly that one.
Yep.
Let's rephrase our findings out of that chart. And here, what I would say is we have a confirmation that our 28 Forex pairs do not behave the same. So we can draw a conclusion like, okay, let's simply divide those 28 here, let's say in 3 categories, just by purpose. So we have the left third, we have the middle third, and the right third. And in this case, I would say mean reversion for the right third, forget it. I would not trade it. We will not find for any optimization good values for that last right third of pairs. In the middle third, we might find good parameters for a mean reversion strategy. And for the left third, we definitely will find good parameters for a mean reversion strategy. So that means the conclusion we can draw here is there is no universal behavior of all the different currency pairs. Therefore, we definitely will not find a one-fits-all strategy, especially if it should be a one-fit-all with one set of parameters strategy. We will never find a strategy like that. Let's call it the nature of the different currency pairs is simply different. And we have already some hints just looking for the names. Australian dollar, New Zealand dollar. Okay, those two countries are close to each other. And I mentioned already another good pair. Australian dollar, Canadian dollar, or New Zealand dollar, Canadian dollar. Those are excellent for mean reversion. Those three currencies have one thing in common. They are commodity Forex currencies, especially Canada and Australia. And New Zealand is, let's say, just close to Australia and has always to follow Australia. I hope I'm not too unpolite, but it's a little bit like that. So those three are quite similar. And that is excellent for a mean reversion strategy if we don't have moves in one direction for a long period of time. But back to the question, can we find something which is universal to all 28? Simple answer as at my very beginning, no, we can't. It's impossible because we have those different characteristics and different dependencies between the different currencies and their relationship. And therefore, we have to pick strategies for example, like mean reversion for those on the left-hand side within the chart we have seen. And for example, for trending strategies, we would more go for Japanese yen, US dollar kind of Forex pairs. They will work better for those currencies.
Yep. Okay. Excellent answer and great question. Thanks, Yam Keller. We've got another one here which is very interesting from Google user 2004. Let me put it on the screen here. Here we go. Does the model check the absence of a strong trend before taking mean reversion trades?
No. The answer is no. So there is no additional filter in this case that we would use something like, okay, let's look for an even longer period in time. Let's say we go for H1 candles. Let's look for the last 120 H1 candles that would represent exactly 1 week. And maybe we could do something like we simply draw a regression line into those 120 candles. So a mathematical regression line, like you do in Excel or whatever. And if that trend, that slope would be too high, that could be an indicator of, hey, that currency pair is, as we speak, too trendy. But the answer is, I don't use that kind of additional filter. On the other hand, I know that if I have that kind of behavior, that the price goes more or less quite straight into one direction, and I open my short trade, in this case, I would end up with a minus trade. Yes, but the reason behind of not using an additional filter is, my general observation is, if I have too many degrees of freedom, and I can always add one additional degree of freedom to any existing trading strategy, and then adding one additional more, of course, every time you do that, the back test results would improve, always, more or less straightforward. But the downside is what I call the predictive power of your trading logic or your set of parameters is getting down and down and down. So you get a tendency of overfitting the historical behavior with any additional filter. And therefore, I always try to reduce my set of parameters to the very minimum. And in this case, we have just three degrees of freedom, EMA period, threshold for entry, and stop loss multiplier or distance. So we just have three, and that is good to have that low number of degrees of freedom.
Okay. I might just finish off with one final question in the chat. There's a bit of a discussion about the use of stop loss, and Tolo's mentioned, I don't use stops, just use small position size and close the trade out if it's not working. And then there's some other comments saying not using a stop loss is a bit crazy. What is your opinion on stops and managing risk in mean reversion trades?
Okay, I even could say we could generalize the question of what about stop losses at all in any trading strategy. And the first is, well, my first answer is, if you and your trading account and your financial situation, or you and if you are trading not only by your own, you trade with other people's money. If your overall risk behavior or risk setting is allowing you that such a trade can have a more or less infinite risk, then you don't need a stop loss at all. Why? So if you can afford such losing trades, I'm fine. I mentioned that a little bit more general. Here we are talking about Forex trades. Okay, let's quickly jump to stock trades. And of course, if I open a real stock trade, so a long trade with physical stops, I don't need a stop loss. Finally, if I can afford the total loss. So if I buy a stock for a price of 100 and the price, that stock company might go bankrupt tomorrow, then I would lose the complete 100. If I can afford that, I'm fine. Why not? Then I don't need a stop loss. For me, I need a stop loss. And I need a stop loss because of different reasons. Because I'm not trading only with my own money. I mean, I have to say people before opening any trade, what is the potential maximum loss within the next week? And if I want to answer such a question more or less serious, then I need stop loss, because otherwise I have more or less unlimited risk. So because of practical reasons, in order to answer those kind of questions, which are really good questions of what is the risk which is involved in following that kind of strategy? I need stop losses. So for me, there's no question. A trade without stop loss is a non-valid trade for Forex, finally.
Yeah.
But it could be different.
Okay, thanks for answering that. And thanks to Tolo and Joey for discussing that in the chat. Very interesting comments. Now, actually, there's one more question that's just popped up. I hope you don't mind me asking this, Stefan. I'm really pushing it now. This one's from Yam Keller again. So let me just put this one on the screen. And then I promise we'll finish up after this one. You can go to bed. Here we go. It should pop up now. How do you deal with the issue of having a statistical significant sample size if you want to perform power analysis? Do you combine a portfolio, or do you want to see each pair have enough trades individually?
So first of all, by the way, quite good question, and here are already quite a lot of good hints of how to answer that question already written in the question. Yeah. So let's first jump into one aspect. I can't read the name, but it's difficult.
I think it's Yam Keller.
Okay.
Something like that. Yep.
Statistical significance. That is a very good point. On the other hand, it's not easy to measure. So it's not as straightforward to measure statistical significance as you might think, but there are ways to measure it. At least you can measure statistical significance in comparison to random behavior, or at least you can ask, how much are you better than a potential random outcome of what you are doing? Or finding parameters for a trading strategy. So therefore, one additional condition to avoid overfitting, I mentioned already neighborhood analysis, walk forward analysis. The next additional point here is indeed statistical significance. And now going back to your question, statistical significance for a single symbol. So every single symbol, or the strategy for a single symbol, has to have a high enough statistical significance, good results, neighborhood analysis, walk forward, and so on, based already on a single symbol. I have to have a good statistical significance.
Yeah.
Complicated word. But anyhow, on the other hand, the next point is true as well. I would never trade a strategy based on a single symbol. We mentioned already, we will not find a one and only strategy or one-fits-all strategy for the complete list of 28 Forex pairs. We have to select the currency pairs, yes. But nevertheless, I would not select such a strategy if finally I only have two pairs which are working with that. Because I want to have more pairs which are working. And as already within the question, I always want to have a portfolio of currency pairs. As we know, the magic of portfolios is they smooth drawdowns, they smooth equity curves if they are traded simultaneously. And definitely we need that, not only to get finally lower portfolio drawdowns in a backtest, forward as well. We always need that kind of portfolio, not only thinking, we need that portfolio trading accounts, because a single pair can do everything, so to say. And we might have a jump upwards, luckily, but we might have a jump downwards in our equity as well.
Yeah.
So therefore we need the portfolio. But the statistical significance, I want to see already on a single symbol level. Because if I would look only to the portfolio level, then I might have within the portfolio 1,000 trades of Australian dollar and New Zealand dollar and 10 trades of New Zealand dollar, Canadian dollar. And then I would be not that lucky. And therefore, I want to have it on a single symbol level already. I want to see the statistical significance.
Yep. All right. Thank you for answering that one, Stefan, and thank you, Kalle, for the question. So I'm conscious that we are well over our time now, and it's very late in the evening for you. So we really appreciate your generosity in hanging around and answering some questions. So thank you very much. Now, if people wanted to discover more from you or to get in touch with you, how can they do that?
Okay, then no problem. Maybe you enter my name once again, because then it will be quite easy how to reach me. If you have that name, maybe you just make a screenshot. That is faster. If you see that name, or you look to the webpage here, my email address, and of course I'm happy to answer emails as well, is simply s. And now the complicated last name, Friedrichowski. You see it, make a screenshot, because the misspelling is quite easy. And then you need at jfdbank.com. That's all. So it's s.friedrichowski at jfdbank.com. And the good thing is, if you enter at least Friedrichowski at Google, you will only find, I think, maybe 10 people on the world with that last name. So it's quite unique. You will reach me. And any email to jfdbank.com having Friedrich something, not only in the address, but just in the text, would finally pop up at my end. So I'm happy to answer emails here as well. So just s.friedrichowski at jfdbank.com.
Excellent. Thank you very much. And I will also share a link to the YouTube video where I discovered your work, and I'll put it just below this video in the description so people can go and have a look at that. As you talk about some of the things we've talked about today, plus some additional stuff as well, so people can go and find more of your work. I think from memory, you actually have some stuff in German on that YouTube channel as well, right? Is that correct?
So you will find a couple of videos, or at least on my YouTube and the JFD YouTube channel. You will find some in English and in German as well. So for all who might be here out of Germany or Austria or Switzerland, you might prefer the German one with less accent. But anyhow, so you will find both languages, English and German.
All right, excellent. Thank you very much again, Stefan. Let's we get some thanks in the chat. So let me just share a few of these and then we'll finish up. So one from Guy. Thanks for the talk. Joey says another great BST show. So actually, before we go, if you enjoyed this show, please hit like on the YouTube thing, and perhaps make a comment as well, and share it with your trading buddies, because the information that Stefan shared with us today is extremely valuable, and we want to get the message out there. There's a comment here. I think it's in German. I hope it's not a swear word. I'm going to put it up ananyway. Fingers crossed. Is that a good comment?
Okay. That's a good one. That's a good one. Many thanks. It just means many thanks.
Okay, good. I had my finger on the button ready to take it off if it was if it wasn't good.
No.
All right. Well, thanks again, Stefan. We really appreciate your time today and everything that you shared. So all the best, and we'll be in touch.
Many thanks. The pleasure was mine, and have a good time.
And thank you everyone for attending, and come back next week. We'll be back to the normal time next week, 7 p.m. Central. I don't have any notes on who the guest is, and I can't remember off the top of my head because it's still early in the morning. So just make sure you come back and check at that time. Thanks everyone. All the best and have a great week next week. Cheers.
Cheers.